President Trump is announcing a finalized trade deal with China. He says the United States will get magnets and rare earth metals from China and that tariffs on Chinese goods will go to 55%. The president also says the U.S. relationship with China is excellent.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host Andrew Ticehurst from our Global Markets Research team, and today's Friday, the 13th of June. Well, we are recording this on Friday the 13th. Let's hope it's not unlucky for some. And you heard Diane Macedo there from ABC News with President Trump announcing during the week that a trade deal with China had been reached. Markets, perhaps rightly, displayed minimal reaction and appear to be seeking confirmation and further details. Ongoing trade, tariff and Trump-related developments remain the single largest driver of global markets right now. And geopolitics is tied up in all this, of course, and another big focus being Trump's 79th birthday celebrations and a grand military parade on Saturday the 14th. That may well have happened by the time you hear this podcast, and let's hope that's gone smoothly. Our focus next week is also on the G7 summit in Canada, which kicks off on the 15th, to see if there are any further trade developments there. And next week, central banks could wrestle back at least some of the attention. On my count, we have at least 8 of those policy meetings to look out for. So in the podcast this week, we're going to whip around the world, checking in with some of Nomura's global research team across New York, London, Tokyo, Hong Kong, and Singapore. We'll discuss all of this and more. There's a lot to look out for, so let's dive in. All right, let's start with the US. I'm delighted to be joined here again by Jeremy Schwartz from our US economics team in New York. Now, Jeremy, we're talking trade this week. Mr. Trump made an announcement. He seems pretty happy. But what's your take? What are the latest developments there with respect to all the negotiations?
Yeah, so we do think the U.S.-China negotiations have been constructive, but our takeaway is that this is really more of a pause in the tensions rather than a substantial turning point. So the agreement announced earlier in the week is light on details and mostly pertains to easing export restrictions, so rare earths from China's side and tech products from the U.S. There was also some de-escalation in the run-up to the London meetings, with, for instance, Chinese airlines resuming Boeing deliveries. There wasn't any progress on tariff rate reductions, though. We're still parsing Trump's comments that the effective rate against China is going to 55%, which read literally would suggest an increase from the current levels. And we continue to expect escalation on sector-specific tariffs, including semiconductors and consumer electronics. Again, I think relative to the past couple of weeks where it really seemed like rhetoric was escalating on both sides, it's constructive that you've reached this detente, that you're kind of seeing both sides attempting to comply with the agreements of the earlier Geneva trade truce. But again, we think that this is a long process. It's likely to escalate and de-escalate over time, and we think this is far from a resolution to the trade conflict. And again, we saw just earlier today, this is Thursday we're recording, Trump announcing the possibilities of kind of unilaterally raising tariff rates, both against specific countries as well as on things like autos and parts.
Okay, got it. So some ups and downs and more of that to come, I guess. Now, Jeremy, this week we also had a bit of a surprise. We had some inflation releases in the US and they were on the softer side. Bond markets seem to pay attention. Yields are lower this week. What was your take on the inflation data?
Yeah, so I think we had downside surprises both on CPI and PPI this week. Our core PCE inflation tracking estimate is all the way down to 0.169% month on month. So very close to a 2% annualized pace. And that's coming after 2 very soft months in March and April as well. So the 3-month annualized rate, if we're correct, would drop all the way down to 1.5%. So in addition to just some overall weakness in inflation data, it's surprising to us that you haven't seen much broad price pressure for core goods, even though tariffs have been in effect for several months now. So the items that we track, the subcomponents which ought to be most sensitive to trade, they have the greatest share of imported final goods as well as imported parts and materials, didn't really see much broad strength. So there were some sporadic pickups in individual items, things like recreation goods have risen sharply for the past couple of months. But very trade-intensive items like autos and apparel were actually surprisingly soft this month. Now, we do continue to expect tariff-driven price pressures to materialize in the next couple of months. We know there was a lot of inventory accumulation in the run-up to the trade war, which potentially eases the cost pressure, and also just a lot of uncertainty over what tariff rates are and where they're going, which might make businesses reluctant to make a decision to move prices. So again, we think this is far from being out of the woods on tariff-driven price pressure, but I think it opens up a possibility that the pass-through could be more modest than us and many economists were anticipating.
Yeah, that's just so interesting. And I guess that sets us up for the Fed. Inflation data is critical for the Fed, and we have the FOMC meeting ahead this coming week. What are your expectations there?
Yeah, so we think that the message and the takeaway from the Fed is likely to be very consistent with their rhetoric over the past couple of months, which has emphasized a patient approach to rate cuts. FedSpeak has been showing a strong consensus for policy to remain on hold, and there's been a lot of indication that the Fed officials don't see much cost to waiting for some more clarity on inflation before resuming rate cuts. That said, despite this consistent message and despite what has been fairly dovish data in the last couple of months, we think there's actually going to be some hawkish adjustments to the dot plot. So in particular, we think the 2025 median dot should increase 25 basis points up to 4 1/8. And what we would recall is that at the March meeting, that was really very early in escalation for the trade conflict. This was before Liberation Day tariff announcements. And even at the time, Powell indicated that maybe there was a bit of inertia to the dot plot in March, and that officials hadn't fully kind of marked to market the trade impact on inflation and how Fed policy ought to respond to that. So we think that there's a little bit of pull towards them doing a bit less rather than a bit more. We think that you do see a couple of dots drift higher to only indicate one cut this year. But that said, we think that the rhetoric, the overall message, and the reaction function is going to be more of the same. Patience, uncertainty, and again, I think emphasizing that even though they're heartened to see some progress on disinflation, they still see risks skewed to the upside and are concerned about both near-term and persistent inflation pressure from tariffs.
Okay, got it, Jeremy. Thanks so much.
Yeah, thank you.
Now, we're going to shift across to China to get an additional perspective on trade talks. And I'm very pleased to have Jing Wang from our China research team here with me. Hi, Jing.
Hi, Andrew. Yeah, thanks for having me here again.
Yeah, no problem. Thank you. So trade negotiations, Mr. Trump thinks he's secured a deal, but I'm curious, what could be the take from China's side? Has official media had anything to say about this?
There is an official statement from Xinhua, following the London negotiation. There still hasn't been much details on what kind of agreement China is willing to reach with the U.S. But one thing is clear: the Chinese official mentioned there is some progress. But other than that, from China's side, we haven't seen much yet. Most of the information we have seen so far are based on, this Wall Street Journal article on this 6-month permit for China to reallow exports of rare earth to the U.S. So I would say, of course, Trump has announced a few things, but perhaps there is not as much as mentioned by him.
Okay, got it, understood. And Jing, finally, just turning to the data calendar next week, we have some important monthly activity data for May coming out. What could that tell us about the health of the Chinese economy?
Yeah, sure. Yeah, so for the monthly active data in May, we expect a broad-based slowdown. For industrial production, we expect its year-on-year growth to drop in May, falling to 5.3%. From 6.1% in April. We think the major drag is from the tariff shock. Our forecast of 5.3% is below the consensus forecast of 6%. But the export growth released earlier this week was weaker than expected. So that should add some convictions to our more cautious forecast for the industrial production. Second, for retail sales, we believe its year-on-year growth is likely to slow as well in May, falling to 4.3% year-on-year from 5.1% in April. The consensus forecast is 4.9%. So again, that's above our forecast. But China is having sustained negative CPI inflation. So that suggests the consumers remain reluctant to spend in China. So overall, regarding the May's activity data, both markets and we are expecting a slowdown from April, but clearly we are more cautious than markets. Regarding our outlook for the economy in the second half of this year, we are expecting a sharp growth slowdown from around 5% year-on-year in the first half to 4% in the second half. And the consensus forecast right now is about 4.2%. So our forecast is clearly more cautious.
Okay, got it. So losing some momentum there and a bit softer through the second half. Jing, that's great. Thanks so much.
Thank you, Andrew.
So let's move to Europe, and I'm very pleased to be joined here again by Josie Anderson from Nomura's European research team. Josie, welcome back to the podcast.
Thanks, Andrew. Great to be here.
Terrific. Now, lots of central banks out next week. Let's start with the Scandies. We've got central bank meetings in Sweden and Norway. What are you expecting there?
Yeah, I think Sweden will be interesting. We actually recently changed our call, now expecting a 25 basis point cut at this June meeting. We previously thought it might be in September. This comes after in the last meeting in May, they signaled that they think there would be slightly more room to cut again. This is in light of all the tariff developments and the high uncertainty there. And indeed, recent GDP growth has come out weak, and also inflation was softer than expected in May. So yeah, we think that that cut will happen now in June. We've also got Norges Bank. Inflation has been a lot stickier there, still remains far too high for a cut right now. So we may expect that they'll maintain the policy rate at 4.5%. We're expecting the first cut there to come in September. We'll have to see how inflation develops for that.
Okay, got it. So one rate cut there. And look, that still leaves Bank of England and the Swiss National Bank as well. Could we see a rate cut from either of those?
On the Bank of England, we think they'll hold at this meeting. They've kind of entered a pattern of quarterly rate cuts. So that would make this meeting a hold. The last meeting was interesting. Two did vote for a bigger 50 basis point cut. The cut was 25 basis points, but two also voted for the rate to be unchanged. We think those two that voted for the bigger cut last time will vote for a cut again this time. But the rest of the Monetary Policy Committee will be more interested in holding rates, given that they have been very concerned about sticky inflation in recent speeches. On the SNB, it's going to be interesting. Obviously, the appreciation of the franc has led to deflation even in the latest figures for May. And so we're expecting a 25 basis point cut there. The question is, could it be even bigger, a 50 basis point cut? And we see quite a high probability of that. 40% probability is what we place on a 50 basis point cut versus 60% of a 25 basis point cut. We think they'll be hesitant because 25 basis points would take the policy rate to zero, 50 basis point would take it negative. They will be cautious about entering negative rates again, especially about the implications for the banking sector there. And so we're only expecting a 25 basis point cut this time and then a further cut in September.
Okay, got it. Good one. That's great. Thanks so much.
Thanks, Andrew.
Now, turning to Japan, I'm joined here by Wichiro Nozaki from Nomura's Tokyo-based research team. Nozaki-san, thank you so much. Great to speak with you.
Thank you. I'm glad to be here.
Excellent. Thanks so much. Now, the Japan-US bilateral summit is scheduled to take place at the G7 summit next week. Will there be an agreement on tariff negotiations?
I believe the possibility of reach an agreement is low. Akazawa, the minister in charge of economic revitalization responsible for tariff negotiation in Japan, has already held 5 rounds of ministerial level talks. And although there seemed to have been some progress in negotiations, a final resolution has not yet been found. Akazawa stated it is unlikely that the Prime Minister Ishiba talk with President Trump and immediately reach a conclusive agreement. Japan's top priority is the 25% tariff on automobiles, but the US side is opposed to lowering tariff in this area. In response, Japan is negotiating using cards such as expanding LNG imports from US and easing import barriers on agriculture and automobiles from US.
Okay, understood. Yeah, I suspect Trump would like a fast deal, but it may not be so easy as you suggest. Now, next week, we also have the Bank of Japan policy meeting to look out for. What are you looking for there?
Regarding the policy rate, we expect the BOJ to keep it at 0.5%. Although the CPI has continuously exceeded 2% target of BOJ, given the high uncertainty surrounding tariffs, the BOJ is anticipated to take a wait and see stance. This view is a market consensus, and the focus of the next meeting is not on the policy rate itself. Instead, there are 2 key points to watch. Firstly, the plan to reduce JGB purchases, which will announce simultaneously. And secondly, how Governor Ueda will present his views on the economy and inflation at the press conference. Regarding the first point, the BOJ currently has a JGB purchases plan through Q1 2026, under which the BOJ has decided to reduce the monthly purchase amount by 400 billion yen each quarter. Nomura expects that the current plan through Q1 2026 will be maintained, and the plan period will be extended by 1 year, with the pace of purchase reduction slowing down from Q2 2026 onward. If the reduction pace is maintained beyond 2026, the amount of government bond purchases in Q1 2027 will fall below the level before former Governor Kuroda introduced QQE. So it is natural to expect a slight slowdown in reduction pace. In addition, it should be noted that the reduction in government bond purchases is intended to encourage autonomous interest rate formation in the market and should be interpreted separately from short-term interest rate control. Regarding the second point, it is unlikely that the BOJ changes its economic and price outlook significantly.
Okay, understood. Yes, I think we have seen long end bond yields under some upward pressure this year, of course. So anything the BOJ has to say about its JGB purchase plan could be quite important. Nozaki-san, thank you so much.
Thank you so much.
Now, elsewhere across Asia, we do have a couple of other central bank meetings to look out for. Lucky for me, Yuben Parajueles from our Singapore-based research team and my podcast co-host is here with me. Hey, Yuben, that was a great podcast you put together from the Investment Forum in Singapore last week. You've set the bar pretty high for me.
Hey, thanks, Andrew. I appreciate that. And yeah, glad to be here on the other side.
Okay, terrific. So let's get into it then. Let's start with the central bank meetings in the Philippines and Taiwan. What are we expecting there?
Yeah, I'd say our view on some monetary policy divergence in the second half will have some confirmation this week from these central banks. So those two, I would say, are the more straightforward calls. So in the Philippines, we expect a 25 basis points cut to 525. That's primarily on the back of inflation remaining really benign. The latest reading is 1.3, so that's below the 2 to 4% target of the central bank. So they have a lot of flexibility. And I would say the tone of the statement will also be dovish, which would set us up nicely for a call that they have another 50 from here. in terms of rate cuts, which would bring the policy rate to 4.75, which is below the 5% neutral estimate. I don't think BSP will go the RBI route, which is a more aggressive 50 basis points cut, because they've already emphasized before that they prefer to stay measured in their approach. In terms of Taiwan, that's also on Thursday. Yeah, we expect them, in contrast, to keep the policy rate unchanged. The economy is doing very, very well. The growth outlook is still very solid, obviously helped by strong export momentum. The AI-related demand for electronics, they're really reaping the benefits of that. And indeed, we are expecting them to keep their growth forecast unchanged at 3.1 in the meeting, again, despite the external backdrop.
Okay, pretty good macro backdrop there in Taiwan. Now, look, that still leaves my large northern neighbour, Bank Indonesia. I know they're meeting next week. Could we get a surprise there?
Yeah, in fact, this one I'd say is a little bit more of a close call, but we did change our view in the sense that we were originally expecting them to cut only in September after cutting last meeting. Now we think they can deliver next week and pull the trigger with another 25 basis points cut. And the key driver for that change is really the fact that the external environment seems to be a little bit more stable. And as you know, Bank Indonesia cares a lot about FX stability. And, with what's happened with the IDR in the last few weeks since the previous meeting, I think they will see this as a window for them to, again, deliver another cut. Because growth really needs a bit of support. The latest high-frequency numbers suggest that domestic demand is still not doing well, and so I think this will be an opportunity for BI to deliver a cut.
Okay, good one. So a steadier currency and a rate cut in Indonesia. Yuban, thanks so much.
Sure.
And finally, I'm going to squeeze in some super quick highlights from my part of the world. In New Zealand, Q1 GDP data will finally be released next week. We think that release could be strong, and with that, we think the Reserve Bank of New Zealand rate cutting cycle is likely drawing towards a close. And in Australia, May labour force data, in contrast, could be weak, easing after an election-related boost in April. And we do think the underlying trend there in the labour market is softening, such that the unemployment rate, currently 4.1%, should start to drift up over the next 6 months. Okay, so there you have it, short and sweet. Our views on major market themes and what to look out for next week. Written by Andrew Ticehurst and the Global Markets Research Team, expertly edited and produced as always by John Dalton. Thank you for listening to our podcast. If you did enjoy listening to the show or want to hear more from Nomura's economists, researchers, or investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log on to nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.